Ray here again, Switch Finance. There's been a lot of talk recently about tightening of lending and borrowing capacities. A bit of talk about DTI, which is debt to income ratio. That's been a big focus of late. So we're going to dig in and answer a few questions around that. So DTI stands for debt to income ratio, and it's a measure the banks have been using for quite some time. So if the total borrowings you have or are going for are going to add up to more than 6 times your total income, and that can include car loans as well, not just property loans. If that's going to exceed 6, then some lenders won't do the deal or put some certain restrictions on there or just scrutinise the deal a lot harsher. So recently our Treasurer Josh Frydenberg made comments around this and indicated that the regulators will start putting a little bit of pressure on banks to tighten up their lending, especially around serviceability, borrowing capacity, and we thought that was going to be around debt to income ratio, but in the honest truth, this has already been happening in the background for the last 18 months, where a lot of banks have been putting restrictions in place around this. What our Treasurer has come out and proposed is that the banks lift the interest rate that they use when they calculate your borrowing capacity. So just to make that clear, whatever the rate that you're being sold, might be 2% for argument's sake, that's not what the bank uses to calculate your borrowing capacity. They use what's called a sensitised rate, which most of them recently have been adding 2.5% to the interest rate that you're actually going to get when they're working out how much you can borrow. And what's been proposed is to increase that sensitisation from 2.5% up to 3%. So just 50 basis points, and that will make a little bit of difference to how much you can borrow, but it will impact more the people that have a lot of borrowing. So people have a larger portfolio of properties, it will curb their borrowing capacity a little bit more, and I think the whole methodology around that is to make it a little bit easier for the first home buyers to get into the market without having so much competition against people that already have properties, multiple properties, or one property buying another. This will make it, I suppose, a little bit fairer and a bit more even playing field for the first home buyers.